All right, well, we're going to get started. Welcome, everyone. I'm Stephen Powers. I'm the co-founder of Open Impact Real Estate. It's a real estate firm that specializes in serving the nonprofit community, and honored to be part of the Nonprofit Resource Hub and presenting to you all today. It should be a really interesting conversation. So much change has happened due to the pandemic, and fortunately, there are some silver linings. And so today we're hoping to talk about some of those. I'll pass it off on to Andrea.
I'm Andrea Cantor, Managing Director at Webster Bank, focusing exclusively on not-for-profit and healthcare clients, helping them with financing and banking services.
Jill?
Yes, good morning. Jill Krumholz from RealHR Solutions. I am co-owner, managing partner, and we are an HR consulting firm primarily focused on the nonprofit sector, and we are thrilled to be here, and I'm pleased to be part of this panel. So I think it'll be a very interesting and kind of intersecting discussion in terms of our backgrounds and what we bring to the table, and hopefully the questions that you will ask.
Fantastic. Well, before we get started, we wanted to go around and ask the group some questions just to sort of get some feedback from you and to what you're experiencing. Just a couple of quick poll questions that we're going to put up on the screen now. So the question is, did you secure a PPP loan or other stimulus funds during the pandemic? So 88% of you did, or 82% of you did. I know a lot of our clients we're worried about having to give the money back. Andrea, I'm just curious to hear your thoughts on this feedback.
Most of our clients did apply for some form of government stimulus, mostly PPP loans, and nearly everyone has had them forgiven because they used the funds as intended, and they qualified for forgiveness. So I think it was great to have that liquidity available to help support operations at a time when revenue might have been off.
All right, the next one. The very basic. Do you own or lease your primary offices? If you don't have a primary office, I guess the answer should be no. Wow, so 67% of you own and 33% of you don't. Or leased. It's very interesting. Most organizations pre-pandemic, I think, would have said yes to this question, unless you're a sole proprietorship. But a lot of people are rethinking the purpose of their office. The question we used to ask everyone that used to be very thought-provoking is, do you even need an office at all? Now that's not such a shocking question because everyone's really thought about that. So, good news is there's a lot of opportunity in the marketplace, way more opportunity in commercial than there ever has been in the past 20 years. So for those of you who do need physical space, it's a real the market is really favorable for tenants and buyers right now. All right, next question. Did you move during the pandemic? So moving your office space, not your home. A lot of people move their homes too, but specifically about office. All right, I think one of our final questions. Did you hire someone outside of New York City metropolitan area because of remote work? So that now that there was a remote work option, you decided to hire someone outside of the metropolitan area. Very interesting. Jill, I'm curious if you had a lot of people were hiring remotely, so that's interesting.
Yeah, that's interesting. That I don't know if everyone sees that response, but it was 50-50 in terms of hiring outside of local area, which is incredibly interesting. What I will say, just to reflect on that, is that I think it was LinkedIn or Indeed that came out with statistics that over a third of people looking for jobs would not look for jobs unless they were remote. So that kind of juxtaposition of 50% only looking locally versus 50% looking externally, outside of the New York area, or outside of where they're located is really very interesting, given how people are focusing on, at least a third focusing on remote work in terms of attracting them.
we had one of our foundation clients grew an entire department based upon remote working, their entire development department. Last question, how many employees do you have? Under 100, between 100 and 250, and over 250? Using this to just help us, gauge our conversation a little bit to cater to the size of your organization. Excellent. Okay. So good mix here. So I'm going to share our screen here. All right, so today we're going to go through these 3 topics of post-pandemic real estate, financing, and people strategies. We're going to jump right in. We already introduced ourselves, but here's a picture in case you like our professional photo more than our real life version. So quickly into the market, as I mentioned, the real estate market got hit really hard by the pandemic. What you're hearing about some of these, Class A deals where, tech companies are moving into big blocks of space, the majority of those deals are happening in these new construction buildings in Hudson Yard and things like One Vanderbilt. But the reality is that the Class B buildings and the buildings that nonprofits occupy have had a lot of increased vacancy and a lot of something we call shadow vacancy, in which although the space isn't technically on the market, people aren't using their space as much and they're thinking about downsizing. And in those buildings, there's been an incredible pressure from landlords to try to keep tenants. And so in most buildings, your landlords are willing to look at you to potentially renegotiate to capture some of the benefits of the current marketplace in return for a longer term, because they really want sticky nonprofit tenants. The good news is unemployment rate is basically back to normal. And while we're seeing subway ridership go up quite a bit, and actually the Metro North train is actually back completely to pre-pandemic levels, office occupancy rates are still quite low. On Mondays and Fridays, the rates are very low. And on Tuesday, Wednesday, and Thursday, as many of you have seen, it's back up, closer to normal, but not quite there. So, almost everyone is seeing the impacts of remote work as part of their occupancy and employment strategy and labor strategy, whether or not they wanted to or not. The employees are demanding this. So as a result, many people are rethinking how they use space when they know that it's sitting vacant 2 days a week. So we track the nonprofit marketplace. The great thing about nonprofits is that everyone files a 990. So there's almost complete transparency in how nonprofits spend their money. And what you'll see here is that larger organizations spend a smaller portion of their budget on their real estate than smaller orgs. Very small orgs oftentimes spend a disproportionate amount on their real estate. And a lot of the smaller orgs right now are thinking about, do I even need an office at all? This is coupled with, how do you create culture and how do you, build energy when you don't have a physical space? And so it's a difficult decision right now, especially when it's sitting vacant on 2 days a week in most organizations. This is looking at how nonprofits spend money based upon the type of organization. So human service organizations and client-facing, public-facing organizations spend a lot more of their budget on real estate than than organizations that are primarily office users, like associations and environmental foundations and the like. And sometimes venue-dependent organizations like theaters will spend over 25%. For education, charter schools by law get 30% of their budget to allocate towards real estate. So that's how much of their budgets they're allocating, because it's such a critical part of how they deliver on mission. So we are also breaking it down by borough, and what you might be surprised by is that Manhattan is one of the lowest rates of occupancy as a percentage of budget compared to the outer boroughs. Areas like the Bronx, Queens, and Brooklyn spend a disproportionate on their real estate. Oftentimes it's because organizations that are headquartered in these boroughs are client-facing and public-facing, human service and the like. So you'll see that, nowadays, and this never has been the case in the past 20 years of working exclusively with nonprofits, there's cheaper space in Manhattan than there is in many areas of the boroughs. We are doing deals at $35 a foot in Class A buildings in Manhattan now, where it used to be $80 a foot, taking advantage of leasehold condominiums, which we'll talk about a little bit later. But essentially, when you wipe away the taxes, the rents can be much lower than in some of the boroughs. So as you know, nonprofit buildings are professional, affordable. They also need to be in accordance with your brand. You don't want to look like an organization that is necessarily spending too much on their real estate, and program and traffic friendly. Sometimes organizations will want to make sure that the security is in line with the type of people that they're serving. They don't want the people that they're coming in to feel uncomfortable in this environment. So we track all these buildings because it's not really relevant to most nonprofits to see the New York City commercial real estate market overall, because they're not in those buildings that are $140 a foot, and they're in buildings that make sense and are affordable. And so this data that we're showing you is for that building set. And what you'll see is that the nonprofit buildings rents are much lower than the Manhattan overall asking rents. So when people are quoting you $70 a foot, that's not really relevant to you. Asking rents right now in most of these buildings is about 160 of them are right around $50 a foot. We also look at it by location. So these are asking rents for the specific nonprofit buildings. And you'll see that in some areas, Midtown Manhattan can be more affordable than areas in the hub area in the Bronx. New construction in the Bronx right now is closer to $50 a foot taking, whereas you can get deals in Midtown Manhattan for inclusive of rent for around $35 a foot in some buildings. Landlords don't want you to know that. So the topic of leasehold condominiums is that nonprofits pay as part of their base rent real estate taxes. So in any normal lease that you're in, you're paying real estate taxes, even though you're a tax-exempt entity. And way back in 1992, Cornell University was threatening to leave the city. And they said, if you want to keep us, you have to find a way for us to not pay taxes as part of our leases. And so the city and the state came up with a method called leasehold condominium structures, in which a 30-year lease is considered ownership so long as it's a lease of an entire condominium. It used to be that this was a really complicated thing to do, and it was very expensive to put these into place, and it would cost $500,000 to set it up. The law has evolved after a number of letter rulings, and now the process has become much more simple. It's really just a lease and the creation of a condominium unit that's part of a no action letter. So it doesn't require a huge condominium declaration like you see in residential. It's a very simple process that the nonprofit can do themselves with the support of the landlord. And what that means is that it's much easier to put this in place, and many, many buildings are now willing to consider it. The savings can be huge. About 25% of your base rent is taxes. So if you're able to remove that from your existing lease, your rent can go down by anywhere between $10 and $35 a foot in some cases. And that's on an annual basis. So if you're in 10,000 square feet of space and you're paying $15 in real estate taxes, that's $150,000 annual savings. And if you look at that over a 30-year period, it's millions and millions of dollars of savings. So, it's great to be able to reduce your occupancy costs, and it's great to also have the ability to, with a long term, to have certainty and also be able to qualify for public money for improvements. But there are some exemptions, and if it's too complicated, sometimes an ICAP benefit, which is in any new construction area, is something that gives you similar benefits for the first 15 years, phasing out over 25 years. Also, if you're in a tax-exempt building or owned by a nonprofit and they're not charging a profit, taxes are already abated. So a lot of the church properties, as well as buildings like the Interchurch Center, have that structure in place. Going quickly through it, the big concern is that this is going to be taken away at some point and that you would otherwise not be able to afford it. Many, many major nonprofits that utilize the structure. So it'd be quite shocking if this were to be taken away, as they would risk bankrupting, many organizations in the nonprofit community. Don't want to have too much time on this, but essentially we try to transfer all of the risk as possible on your landlord. In this marketplace, you have the ability to ask your landlord to essentially pay for all of this, pay for the architectural fees, and take on the risk of paying your taxes during the period while you're waiting for the exemption to go into place. We're currently doing this with a number of organizations in the city, getting things like 24 months of free rent to cover relocation costs, full turnkeys from the landlords, and the ability for them to pay for all the costs associated with putting this in place. The real risk here is that in order to be ready to do this, you have to be willing to be in a 30-plus-year commitment, and you have to be willing to be a large enough tenant so that it makes sense. Generally, a full floor tenant or more, or 10,000 square feet or more, is large enough for this to make sense. So that was a quick whirlwind on the real estate market. Jumping into people solutions now with Jill.
Yes. So thank you, Stephen. I want to go back for a second, and I really want to thank Ava Rice for her presentation and opening this morning. Your honesty and the important conversation that you were having is really critical for all of us in terms of working in the nonprofit space. So thank you for being so open and honest, for sharing your personal background, for speaking about your organization and how you're moving the needle. And really how you're doing work for people of color. So as a HR consulting firm, RealHR Solutions works primarily with nonprofit organizations and very heavily on the client service provider side. So what we're seeing, and just as a segue to what Stephen was saying, we're seeing organizations over the last few years shrinking in terms of their space. And certainly that has been a result of, the desire for people to be working remotely, the need for people to be working remotely initially, and now the increased desire for employees to be working remotely. So what we have seen over time, and certainly initially, was that after locations opened again, fewer people were coming in, more consolidated time. And again, back to what Stephen said, very often what we're seeing is Tuesday, Wednesdays, and Thursdays tend to be a time where organizations are asking people to come into the office if there is a hybrid situation. I think that we have all found it so incredibly interesting to see how work has shifted and how organizations and employees and organizations are doing an incredible job at creating culture, managing communications, growing communications, and getting productivity out of employees that are both remote and on site. I could go on and on. And so I think as we move forward, we'll talk a little bit, about some of the strategies for recruitment, as well as employee development, and really looking at equity as it relates to salaries, compensation, benefits, as well as other, DEI programs. And DEI is really about practices, right? It's not a program. It's really around very broad-based practices that really help to change your organization and to attract the people and manage the people internally that you really want in your organization going forward. So Andrea, I'll turn it over to you just in terms of some introduction initially.
In terms of, we talked earlier at the outset about the impact of the pandemic. And I would say staffing was one of the biggest challenges that came out of the pandemic, both during and now after, although we're still really in it. But, in terms of all hands on deck, finance doesn't live in a silo. Everybody was involved in obtaining PPE and safety protocols for staff, and especially direct service professionals who are in direct contact with clients, and of course the safety of clients and the need to finance some of those extra needs with hazard pay and the need for PPP loans. So, I think the intersection of finance and staffing really came together, and especially at the height of the pandemic, the early months, when we were all still absorbing what was really happening to us. One of the things that happened as well from a financial perspective is that some organizations right before the pandemic and even during the pandemic were selling properties to monetize the value of certain assets, as well as purchasing properties because interest rates were low. And so we definitely saw real estate activity through the pandemic, despite the uncertainty, and that had an impact on financing. But I think in terms of the intersection of staffing and finance, it really, really is about reacting to the pandemic and now the new workforce.
Hiring strategies and in fact, the finance and hiring and employee growth and development and retention are all so heavily connected. So in terms of hiring strategies, really what we are seeing is, and I'm just going to go back to Avra's numbers in terms of the millions and millions, 84 million people in 2020 that left jobs, and then the 4 additional million the year after. So it continues and will continue to be a really difficult marketplace. And, you've heard this, but I can't stress it enough. It is a candidates market, and it will continue to be for a long time. So what do organizations do? They look at really, I think, best practices are such that they're really looking at what are the skill sets needed, how can they reskill internally, where does technology play a part? And it plays a huge part in terms of bringing people in who have that skill set, but also developing technology in the organization to be a more effective organization. Rehiring of people, organizations over the years, I recall where they'd say, well, people left, I'm not going to rehire them. I think there's really a real big push that employers are looking to bring in people that were there and did a really good job, know their culture, and can kind of hit the ground running. Certainly there is looking at different generations and what the value is, and potentially really looking at people who are later career, who would be interested in getting back into the workplace and who are very passionate about nonprofits and missions. So I think that, and I think for some of you who've heard me speak before, I also feel so strongly about the importance of marketing your organization, not just for the support you get from donors, but really creating a marketing strategy to increase your hiring efforts. I think that's critical in terms of being competitive in this marketplace.
Jill, I'm curious if there are any
Yeah.
examples of organizations you've seen who have used remote work to be able to tap into a labor pool that they otherwise wouldn't have been able to pre-pandemic.
Sure. So of the nonprofits we work with, I'll kind of give you a breakdown, and this is a microcosm, right? But probably 20% of our clients are working totally remote, and that could be across the country. And probably some people are even out of the country, right? So, and there also are implications around that in terms of how do you develop, communicate, maintain culture, and so forth. But clearly there are many organizations that have gone the remote route. And certainly what we know is that the diversity of not just of gender and color, right, and sex, but it really is around diversity of thought, people from different parts of the country, different orientations, and it has really expanded capabilities. And it's really been a double-edged sword, because in some ways it's difficult because you're getting out of what you're accustomed to in terms of your culture, but it is really opportunity to build culture in a very, very different way. And what I'm seeing is that leaders are stepping up in a way that not only are they looking at how they lead, but how it's become such an employee-centric culture in terms of work, that it's really critical that where organizations can, that they create a hybrid situation or remote situation. And again, the onus then is on the employee and the organization to make sure that there are programs and practices that bring those people together. So it really, there's some great benefits. And again, a lot of it is around that you're opening up a much larger employee pool population.
So to that same point, Jill, I'm curious, folks that are intentionally hiring remotely, like fully remote positions, not just people who are, remote part-time, what are some things that successful nonprofits are doing to make sure that those employees are feeling like they have a seat at the table, that they're part of the organization and part of the culture?
Sure. So, I would say that whether if we think about organizations and hiring, okay, whether you are, and I'll first respond by saying whether you are on-site or remote, the need and the focus on onboarding, and onboarding starting before you hire someone, right? But the entire process of recruiting. Onboarding starts there. Access to the window to your organization starts during that process. But the onboarding process is critical, and it becomes even more critical when you're looking at people who are remote. So I think successful organizations, while it takes time to have meetings, I think successful organizations are doing a good job in remote situations of having meetings, introducing folks, doing cross-functional meetings, having remote events so that people become assimilated into the organization. Mentoring programs is critical. Having buddies, having developmental opportunities that are potentially online, so that people are able to develop on their own. Technology is so critical as we're going forward. It always has been, but in terms of a remote employee base, it is so critical. So it really is access to technology. It's access to employees and to departments across the business, so across the organization, so people can very quickly understand their role in relation to other people's roles, other department roles, and so true assimilation into the organization. And I'll go back a little bit, which is really around hiring and communicating your values, communicating principles, really helping someone who's coming into the organization, one, identify whether they feel an alignment with your organization, and then two, spending a great deal of time assimilating, onboarding, and helping them to live those values. And that requires, there's a lot of pressure on leaders, on managers, but also on employees. And I would say that in our firm, we feel like it's a very, very exciting time for businesses. And certainly for HR, I feel like in all the years I've been in HR, it's really in fact been stressful and never really as exciting as it is now.
So one more question about that is, I've seen some of the nonprofits we work with who have remote teams, that they're being intentional about creating culture by having, a couple times a year coming into the offices for days where they're able to collaborate and to do trainings and to build culture and to sort of have fun together as an organization. Are you seeing those types of things? Is there an example of a particular type of culture building activity that you can reference?
Sure. So I'm going to go back to 2020, and when pre-pandemic, I'm going to go back to a little thing that one of our clients did, and a small nonprofit, about 30 employees, and people were in the office, and on Fridays, everyone would stop at 5 o'clock and they applaud themselves. It just became a thing, and they would applaud themselves. Everyone made sure they were either in that room or in areas where the surrounding rooms. And then that followed suit remotely. And so people would get on for 5 minutes at 5 o'clock on Friday, and everyone would applaud themselves, right? So little thing, but I can't tell you the excitement that generated. And I actually joined, that was a client we joined and they were already doing that. So kudos to them. I think it's really critical because you don't have the water cooler conversation, that there really be some camaraderie that's very intentional and purposeful. We are all burnt out from meetings. Many of us are not showing our faces at meetings anymore, where that was a really strict and important protocol. It really is about having fun at work, getting to know people better. I will say that after 2.5 years of being remote, our firm actually went up to an outdoor sculpture park last week, and many of us had not met each other. Didn't do a work thing. It was not a team building. It was just meeting and enjoying each other. And it really goes a really long way. And I'm sure in your organizations, and Andrea, I'm sure you're finding with Webster that, you know, you're doing a lot in terms of connecting people.
Absolutely.
Yeah, in a very human way, right? So we, you know, the whole concept of we take our whole selves to work is so critical in 2022, that it's not just about getting together or getting on a Zoom or meeting twice a year to have very stringent kinds of work activities, but it's really much more than that.
So
Jill, I love your, oh, sorry.
Go ahead, Andrew.
Jill, thank you. Jill, I love your comments about culture and values and leadership, because crises are when the best comes out, or not, right? And I think that the challenges from the pandemic and beyond with the changing landscape in the workplace is such an opportunity for leaders to make the differences. And you were saying your client was already having some of those meetings before they were working with you. And I'm sure you've been able to share all of that with new clients. It's so important. I'm, as a lender, I'm all for organizations saving money if they can save money in real estate or hire in less expensive markets for employees. So I'm all for that. I'm all for saving money. But I fear the disruption to the workplace that could have a negative impact on mission. And so it is so important for organizations taking advantage of opportunities to save money in one area, to put a little bit and invest in things like leadership and values and culture, because that's investing in mission. So I just really wanted to emphasize those points. I think they're so important.
I think that's so interesting because, and to your point, Andrea, you know, there's money that needs to be spent in certain areas without a doubt. Believe it or not, you know, investing in HR doesn't mean dollar signs constantly, right? You know, it's smart hiring, it's possibly hiring part-time folks. It is learning to be creative with who you have. But in terms of even training, you know, it's how do you find things that are going to support your employees, help them to develop. Maybe it's an online program. You don't need to spend $100,000 to have, you know, someone come in-house and do training. Doesn't work anyway anymore, but, you know, not even remote. So I think that there are so many things that can be done with organizations. And, you know, we talk about the fact that communication is, you know, critical. Building an organization and building culture is everything these days. And they don't have to cost a lot. What I will share, and I will talk a little bit about one, certainly health and safety is a tremendous focus, and people's health, both physically and emotionally never as much have employees felt the responsibility of employees' emotional health. More and more we're seeing that, and that's pretty terrific. And I won't get political about it, but I think it's pretty terrific. And I think the other thing is, and this is where there's a real strain for nonprofits, for those of you who are thinking about this, you know, the whole concept of salaries and equitable salaries, benefits, you know, what are you affording your employees? What is it that they need at this point? Those are things that really are probably where you wind up spending your money these days. And I would say more and more clients are coming to us and saying, okay, hiring retention means looking at the organization, determining what employees' needs are, how do we retain them, what do salaries look like, what do benefits look like, how are we competitive, right? And one of the things that we're learning is that employees don't necessarily. Benefits brokers, and many of them have been on today, and I think so highly of them, colleagues of mine. Really good benefit brokers are important so that your employees understand what their benefits are. I think that so often employers are ready to change their employee benefits, look for a new broker, look for a new plan. And sometimes it's really a matter of looking at what your benefits are and identifying what's not being used, what's not being understood, right? And going from there. I think that what you'll see a lot of is this, there's a lot of conversation around, and I think a real focus on total rewards, which is what is your total rewards philosophy? How does that fit in? Certainly from the standpoint of more and more states requiring salary transparency, there is really a, this is a push-pull, right? Salary transparency is wonderful for attracting talent. You get to put your salaries up. You get to talk about not just the salaries, but what benefits you have. So you use that as a marketing tool. On the other hand, you then have to look at what's happening internally in terms of your salary and equity, and do some hard looking and evaluating and benchmarking of your rewards practices.
That's great. I want to offer the opportunity to pivot and to start talking about, you mentioned, Andrea, the intersection of financing and HR. And it's a really complicated time right now for nonprofits looking at financing in this inflationary environment. I'm curious to hear, what has the impact of the pandemic been on your financing options? Has it had a huge impact, or some things still the same, or have a lot of things changed?
In some ways, certain things didn't change at all, or maybe just got a little more emphasized. Organizations still need working capital, especially here in New York, to bridge the gaps between invoicing funders for services provided and getting paid for those services. It's a huge issue here in New York. It's not the easiest system to navigate. And so working capital has never been more important, but it's been important for a very long time. And so banks provide, significant amounts of working capital to the industry broadly. So that's something that I would say didn't change terribly much. In terms of larger loans for investment in real property, those kinds of transactions slowed down for a while because there was uncertainty. And as the pandemic kind of calmed down a little bit, we all kind of got used to what was happening and started to accept the new normal. Transactions started to happen again, as Stephen, I'm sure you've seen on the real estate side, that more organizations were looking to make changes, looking at new opportunities in real estate. So I would say that, the deal volume seems to have perked up a bit, in this past year versus, the second half, most of 2020 and 2021. So it does seem like things have come back online. But at the same time, we have the changing landscape in the economy, and with interest rates. And so that has a huge impact on the real estate market. And again, presents volatility and changes what the opportunities are, changes financing costs, and has an impact on acquisition costs as well.
You mentioned the line of credit need being exacerbated during the pandemic. We heard a lot of stories in the news, and we've heard from our clients directly that getting paid by the city has become even more challenging during the pandemic. And I know that certain sectors like education got hit particularly hard, and some providers had to even shut down portions of their operations because they couldn't afford to keep bankrolling the city. I'm curious to hear, if you were to quantify the impact on sort of the needs of nonprofits, how much did they grow? How many more months of line of credit did they need versus pre-pandemic?
I didn't notice it that much in that sense. I feel like the city's timing has been about the same, as well as, candidly, the various counties, Long Island, and moving towards upstate, Westchester, et cetera. I haven't noticed that big a change in terms of how many months of financing they need. I feel like the timing isn't that bad. It's bad overall, but it didn't get that much worse. But what I did see was a lot of unexpected expenses that, you know, may or may not be reimbursed. All of the scramble for PPE, for example. Remember the protective equipment, more masking, more people had shields, and even even organizations that operate in healthcare, where they normally have masks and those paper robes that you might put over your clothing to enter. They have those things on hand, but not the quantity that they needed, you know, in the worst of the pandemic. So those were unbudgeted expenses that, again, fortunately, things like PPP came around, and organizations were able to leverage that government support. Because it's not easy to handle, you know, tens of thousands of dollars and perhaps millions of dollars for some larger agencies of unexpected, unbudgeted costs.
Absolutely. So, you know, there's a lot of talk about different sources of funds for nonprofits, and, you know, traditional financing still exists. You know, you can get a traditional bank loan. What types of traditional financing are available to nonprofits right now? And I know that you can't speak to exactly, you know, rates, but how do rates change from, you know, based on the type of organization you are and the size you are, also based on the type of thing that you're looking to finance, and then finally the duration of a loan?
Great questions. And I just want to say at the outset that nothing I'm going to say is prescriptive, and you know, every organization is unique and has a unique set of circumstances. So while we say traditional financing, I don't want anyone to think that lenders are kind of handing you an off the shelf solution. It really is no such thing, because when you're talking about bank financing, there's a lot that gets negotiated. And so, you know, covenants change, pricing changes, and there are some unique circumstances that I'm going to address now that have come up because of the pandemic. So to start with, when we talk about traditional financing, obviously there's lines of credit, which I talked a bit about already, generally used to bridge timing differences. Another form of traditional financing is a mortgage on a property that an organization is purchasing or investing in terms of a renovation. And so mortgages are a great way to finance that kind of a need. You know, property and investment in property, like a build out and furnishings, those are long-term investments. And so financing them with a long-term loan, you know, often makes sense. Lenders talk about wanting to match the loan to its purpose. So that's a great example. If you're investing in a property that you're likely to own for a long period of time, just like your home on the retail side of banking, you know, it's the same kind of thing. If an organization is going to have a property for a long time, long-term financing tends to make the most sense. The variables that change that are unique are things like covenants, which are promises that the organization makes to live up to certain financial ratios, for example. That's an example of a financial covenant. Could be debt service coverage, where there's a definition of cash flow supporting the loan, the debt service, the principal and interest payments that might be required. A variable could be if there's a build out and the loan is going to be drawn down over time, how long will that build out period be? The bank is going to want to see the budget for the project, and they're going to want to know who's the general contractor, how is this work going to happen, what's the timeline. And, you know, along with lots of other things, we've seen increases in those budgets for renovations because of increased labor costs and increased costs of the materials that are being used in a renovation. So there definitely has been an increase on that side. And it all plays into how much money does the organization need to borrow, and can they afford it? Can they pay us back? So that comes into play. Those are some of the variables. I know you asked about interest rates. And so I think that people generally understand, but I'll say it in case, is that, you know, the better an organization's credit worthiness, the stronger they are as an organization, not only financially, and which is sort of quantitative, but also qualitatively. It goes into an organization's borrowing costs, because if if they're always short on cash and not competing well with other agencies for contracts, and just have a variety of headwinds, it's going to be harder to lend to them, and it's going to be more expensive for them to borrow.
Interesting. And are you seeing, the long, like I have heard in a number of circumstances that there's not an exact correlation between the level of interest rates and the rates that you're actually charging the nonprofit, because there was some expectation that rates are going to come down in the future. Is that something that we're still seeing, or is that no longer the case?
Not to get too fancy on this call, but banks price loans usually as a function of either their cost of funds and or in combination with the yield curve. So, traditionally the normal curve is that it's less expensive to borrow under a line of credit, which is revolving and, has to get paid back. If it doesn't get renewed, has to get paid back at the end of the period, which is usually a year. So usually that interest rate would be lower than, say, a 10 or 15-year loan on a mortgage on a property. So, that's the normal yield curve. We've had a flat curve for a long time, and for quite some time. And so there's not as much of a differential as there used to be in terms of how the term of the loan affects the pricing. But, all of the things being equal, we do return to a normal curve over time.
That's great. Thank you.
Mm-hmm.
So one of the things that's really fantastic about being a tax-exempt entity is that you have access to tax-exempt financing options. What are some of the different types of tax-exempt financing options, and how do they benefit nonprofits?
Yeah. So again, not cookie cutter, but some general terms about tax-exempt financing is that most often an organization will tap the tax-exempt market if they're acquiring or improving real property. And you need a lot of partners at the table to work on a tax-exempt financing. So an organization is going to want to speak to a lawyer, speak to their lender, speak to a financial advisor who is a specialist, like a special type of investment banker that works with nonprofits on tax-exempt financing. They're complicated at the front end, but then once you have a tax-exempt loan from a bank, for example, it's just like a loan. You're going to service that debt probably on a monthly basis with a principal and interest payment. But that's only one kind of tax-exempt financing, is where an organization issues a bond through a conduit issuer, and the bank buys the bond. And then thereafter, it's kind of like a loan. But there are a lot of other kinds of tax-exempt financing. Another kind is where those bonds are issued publicly. I wouldn't be involved in that because I'm a bank lender, but there are plenty of financial institutions that can take a public issue to market and issue those securities publicly. That tends to be available to much higher quality borrowers, like universities, big healthcare systems tend to tap the public market. But what I'll call the bank market for tax-exempt financing, it ends up looking a lot like a loan at the end of the day, but at the front end, there's a lot of complication. It's not a simple transaction to put in place.
So just high order of magnitude, the benefit of tax-exempt financing that you're going to get a reduction in cost of the loan. What can you expect? Like, how much of a savings is there?
Yeah, thank you. I forgot that part of your question earlier. So the advantage to the borrower of issuing tax-exempt debt is that the interest rate is lower. Just like municipalities that, people refer to the muni market, they borrow at a lower rate than an equivalent corporate. So if a corporate entity, a for-profit corporation, is rated single A, they're going to borrow at a particular rate in the market based on their risk, on their credit rating, on their debt rating, and an equivalent single A municipality is going to have a lower cost of borrowing in the market. So that's kind of the best analogy. People seem more familiar with munis. So you're right, there's a lower cost. And your question about how much lower depends on who's going to invest in the security. So it depends on what bank you're going to borrow from. Every lender will have a different tax factor. The same way, if a retail investor like we are goes into the market to buy a municipal bond, it depends on what our tax rate is. So it's the same thing with an institutional lender. and the public markets, it really depends on the tax rate of the investor in your bonds. Sorry if this is getting a little complicated.
No.
Tax-exempt financing is a whole other seminar, but the big takeaway about tax-exempt financing for anyone listening today is it's a little complicated at the front end. It can save you a lot of money, and you need professional advice to decide whether it's for you. That's your financial advisor. Any banker can probably point you in the right direction. Your real estate advisor, your counsel, you need some professionals at the table.
So the type of investor based upon their tax rate is essentially the equivalent. So if someone is paying taxes at 22%, then you have around that level of savings. And if their income tax is much higher, then it could be even higher than that, right?
Yes, and so that's a good example. If a bank or any investor has a corporate tax rate of 22%, then it's a 78%. You're going to pay 78%. I mean, they're probably going to quote the rate that way. But I think it's important to know that not all banks have the same tax rate. Everybody has a different effective tax rate, so when you get your term sheets, they're all going to have, slight differences. And that's going to be one of them for sure, is the tax factor.
That's great. One more question on this, not about taxes and bond financing, but specifically nonprofits have other sources of financing available to them, such as community banks that are willing to make loans that are mission oriented.
Yes.
While the rates might not be necessarily that different, the availability is different, right? How can a nonprofit navigate that world, and what are some of the types of financing available to nonprofits?
Yeah, that's a great question. And there are so many sources. There are CDFIs all over the country, and especially here in New York, that specialize in lending to certain types of nonprofit organizations and community organizations. There are specialized banks that have a mission, and a lot of these are other they themselves are nonprofits. Like a CDFI is a type of nonprofit, but they're in the business of lending. So their own borrowing costs are going to be different, but they're very mission oriented. The best way to find out about some of these opportunities is word of mouth. And the city also can be, New York City has websites that talk about different opportunities. There really are a lot of other opportunities. There's also new markets tax credits, another complicated source of financing. But again, complicated at the front end, but in the long run can be very effective for a nonprofit organization. But I would say word of mouth, asking other CFOs and other executive directors, networking with board members, looking on the internet, the same way you might find other referrals, talk to your network.
That's awesome. Yeah, I remember when new market tax credits was first being discussed, people didn't know if the amount of that 20%, I believe it is, of equity that was essentially given by the structure itself would be forgiven or not. And everyone was nervous that it was going to get taken away, but that didn't happen, right? So those organizations really got the benefit of that free 20% equity.
That's my understanding too. I haven't worked on one in a while, but that was my understanding too. And I think these things evolve. These programs that get put in place come from a good place. It's an incentive for organizations to make these investments in their long-term future by allowing them to borrow tax exempt, for example. That's a form of the government encouraging those kinds of investments to be made. Sometimes there are unintended consequences, and so the programs change, some of the rules change along the way, and they evolve, but they're all coming from a really good place of trying to help nonprofits make long-term investments in their missions.
Great. So just gonna finish up with an example of a success story. For organizations that do have the ability to think about long-term new commitments, some of the things that we've seen, the combination of all these things together. So this is an example of an organization that was able to reduce their footprint from 60,000 square feet to 45,000 square feet. They were able to think about using remote work as a way to reduce that footprint, and also was really intentional about making sure that groups that needed to work together would be in the office at the same time, but having a ratio of really 1.6 people sharing one desk, or for example, 6 5 people sharing 4 desks is a really manageable ratio. But some organizations are literally a 4-to-1 ratio in reducing their footprint. So, you know, there's a lot of silver linings out there in the market right now. And it's an opportunity to make some important changes and to take advantage of a really incredible real estate market, and landlords and nonprofits actually having leverage right now to be able to reduce their expense and lock in good deals for the long run. We're at the end of our seminar here. I know this is a ton of information. Everyone on this panel is interested in being a resource to you. Please reach out to us if you have any additional questions. Our emails here on the below, and if you are interested in any of these materials, please email us and we'll send them along or set up a time to talk to you. Thank you all for coming. We really appreciate it.
Thank you.
Thank you.